So let's go to May 13th, 2008. And the options that we had available were the June options. And I purchased, the stock was trading at $15.95 at the time. I bought it for $16. And I purchased a slightly in the money put option at $16. In other words, I felt that the downside risk of the potential of the stock was pretty low. But however, I didn't buy a lower strike price. I bought the strike price. I bought the put option as insurance at the same strike price as the stock. In other words, if my stock went down, if I bought it at $16 and I bought the $16 put, if it went down to $15, I would have gotten paid $1,000. That put option would be worth $1,000 minus what I paid for it, so I only would have lost the 68 cents that I would have purchased it for, or approximately $680. Do you see why that is the case? Because if the stock falls $1, I lose $1,000 on the shares of the stock, but I gain 42 cents because that $16 put now will be worth $1 if the stock drops to $15. So I've made a $420 profit on that. However, I paid 68 cents for it, so that's my maximum risk. So my maximum risk was $68 or $680 on the stock. Even if it fell to $14, I still would have had a maximum loss of $680 on the stock. Now, as we advance, the price of the put option declined. However, the price of the stock increased. Now my $16 puts are only worth 25 cents. I lost $400 because I paid 68 cents for these. I lost approximately $65 or $650 on this particular option. However, since I purchased the stock at $16, I made $1,000 on the price of the shares of the stock. So I made money. I let the stock prove itself. In other words, when I opened the position, I wanted as much protection as I possibly could get. As the stock advanced in price, advanced in price, my option, the $16 put, declined dramatically. However, I made $2,033 on this, on the $2,333 on the stock, but I lost because my $16 put option now is only worth about 5 cents if I wanted to sell it. So I lost approximately 63 cents or $630 on the put option, my insurance. At this point, since the price of the stock is farther above my strike price here, I still have a $2 limited. I still have a $2 potential loss or $2,000 potential loss in the stock if the stock went back to $16. Since I lost approximately $630 in the stock, but I have a $2,333 profit in this. I'm sorry, if I lost $630 in this put option, and I have a $2,333 profit in the stock, that still leaves me with approximately $1,500 in profit, closer to $1,800 in profit. I took some of the $1,800 in profit to purchase additional protection. I still have these 10 $16 put options. However, at the time, I also purchased another 5 of these $18 put options as additional insurance, which cost me an additional $200. That $200 came out of my profits. So not only did I lose 63 cents here, but I purchased another insurance policy at a higher strike price for an additional $200. That's $800 in cost for my insurance. I still have a profit of approximately $1,500 on the increase in the shares of the Starbucks stock. as we get closer to expiration, what I would do is if the stock continued to increase in price, I would roll over the put options that I have available here and roll them into the next month's strike price, into the next month's options. Put options is insurance. Now, depending on where the stock is, I would either go a little bit lower, because remember, now I have some built-in profit. I have approximately $2,333 in profit at this time. I don't need as much protection now because I do have a cushion of profit in the stock. So I could now sell these I have 10 of these $16 put options. I could sell those excuse me, and purchase an additional 10 of these $16 put options for 17 cents. It would cost me an additional $120. However, I've also got additional protection because now I'm 50 days out in protection. I could also purchase 10 of the 1750 strike price options, which would give me even more additional protection on the downside risk of my stock. Because at that point, it's almost like I have locked in the profits minus about $1, because as the price of the stock goes up, I can also continue to roll up my protection underneath that to lock in the profits that I have. After the stock has proven itself, it's up $2.33 from where I purchased it, I would not be so inclined to purchase an in-the-money put option in order to limit my downside risk at this point. I would certainly roll up the strike prices of my puts to be a little bit closer to the money. For example, a $17.50 put would be a much more attractive option to me because of the lower cost. But I would not do that initially because my potential exposure to the downside on a brand new position is much larger. So I would want the stock to have a lower risk on the initial position if it did decline on me. So I would have a maximum loss here of only $440. The stock has proven itself and moved up. So now I can roll up my strike prices, but I also don't have to go as deep in the money. I can go at the 1750 level and still have enough protection at a lower cost as the stock continued to increase. Now, as the stock increased, let's say we go out to October. If the stock was, at a decent level, so if it was above $25 or it continued to rise in price, I would continue to roll up my put options each and every month that I held this position. And you might be asking yourself, well, why would you continue to purchase insurance on the stock if, in fact, it has gone from $16 to, let's say, $25? You have a fairly large profit in the stock already. Why would you continue to roll up your puts? Because I do not use stop losses. And here's the reason. Let's go back to our Starbucks stock just for a second again. Let's say you purchased Starbucks stock right here. On this particular day, it was selling for you could have easily purchased it between $17.70 and $17.85. Now, if you purchased the stock at that point and you said, okay, well, you know what I'm going to do? I'm going to set a stop loss on the stock and I'm going to have it held with my brokerage company so that I want it to be sold at the low of this previous bar, which was $17.40. So you set a stop loss and you had absolutely no other type of protection. You didn't have any of the put options that we were discussing. Well, to your surprise, the very next day, the stock opens at $15, approximately $16. Your stop loss order was transferred to a market order, and your stock was sold rather than at the price that you determined would be your stop loss at $17.40. It was actually sold at $16 at the opening price of the stock. Your stop loss was triggered. it turned into a market order, and now you've sold out your entire position at $16, much lower, $1.40 lower than you had anticipated.